here are 4.5 times when you should absolutely not be using an S corporation. And I love S corporations. They're phenomenal for saving huge amounts of self-employment tax, which we're talking big dollars, like over $10,000 a year for most entrepreneurs that they're saving by using an S corporation. They're wonderful, but they're not to be used all the time. They're not right for all circumstances, and way too often they're treated as this blanket solution for any kind of business that you're involved in, and that simply is not the fact. So today I want to review the 4.5 times that you should not be using an S corporation in your business. Here we go. The first time is when you have multiple owners. The reason why you don't want to use an S corporation when you have multiple owners is because it gets messy. And what if you start another business? Now you have one S corporation for business number 1, another S corporation for business number 2. Now you've got to pay yourself wages from both of those S corporations. Well, we're starting to defeat the whole purpose of this, because now we've got 2 wages. The whole reason is to keep those wages as low as possible so that we're paying as little as possible in employment taxes. So here's the way to do it. If you have 2 owners, owner 1, oh, that's not the right one, owner 1 and owner 2, owner 1 is going to have their own S corporation, usually an LLC filing as an S corp. And they own this 100%. And owner 2 has their own LLC filing as an S corp that they own 100% of. Now, down at the actual operating business level, we have an LLC that is not an S corporation. Because an S corp, it's very difficult for an S corp to own another S corp. So this business is a partnership. And the partnership can be owned by the S corporations rather than by the individuals themselves. So this does 2 things. One, it keeps the partnership really clean. You don't have to worry about one partner wanting to buy a really expensive car and deduct it while the other partner buys a much less expensive car. And you got to figure out a way to make that equitable for both partners. And the car is just one example. That happens all the time. And what happens is partners end up leaving deductions on the table because they can't figure out a way to make it fair between the 2 partners. Well, doing it this way eliminates that question of fairness from the equation, because you can keep it really simple at the partnership level. And then each individual owner is an S corporation, and the owners own the S corporations. You can deduct all the stuff you want to deduct right here at your own S corporation level without having to worry about the other partner. The other reason is you only have one wage. You only have one W-2 coming up to you as the owner. So if you ever get involved in more businesses, and people who are involved in partnerships are generally over time involved in more than one partnership. So as you have other businesses going on, you don't have to have separate W-2s from each of these businesses. Everything funnels into your one S corporation. Pay yourself one wage. You get everything deducted right there in that S corporation. And it's simple and it's clean and it saves you more tax because you only have one wage that you have to pay. The second time that you do not need an S corp or even want an S corp is when you're really just starting off. So when you're first starting off, you want to open that little LLC, but you don't want to elect to have it filed as an S corporation yet. Just have the LLC there, then you can elect it when you're ready, when your profit clears at least $20,000. The reason why is because your self-employment tax is 15.3%. 15.3% of $20,000 is only what, like $3,060? It's not a small amount of money, but the problem is an S corporation doesn't get rid of all that tax completely. What it does is you have to pay yourself a W-2 for some portion of that. So let's say, and the W-2 has to be reasonable. So reasonable for these smaller numbers means like smaller profit number means a larger percentage of that profit needs to be a W-2. So you probably really are only going to save yourself about $1,500 in tax. And by the time you cover the cost to file the payroll, the cost to file the tax return, and the headache of doing all that stuff, that $1,500 of savings generally just isn't worth it or isn't even there by the time you cover all those extra costs. So wait till you're over at least $20,000. Definitely by the time you hit $30,000, and we're talking profit, not revenue, then you should be an S corporation. It's between that 20 and 30. That kind of depends on your situation. But under 20,000, don't bother with an S corporation. Now, the third reason is actually the opposite. As your income goes up and up and up. So for entrepreneurs who are doing really well, if you're making about $500,000 or so in taxable profit from your business, then an S corporation starts to have diminishing benefits to you. And the reason for that is a couple. One, to pay yourself a reasonable salary, it's really high. And so then you're kind of defeating the purpose because you're paying those taxes on your payroll anyway. And the second reason is you start to get into really high income tax rates. So now you're paying 37% income tax rate at the federal level. By the way, this is for married filing joint. If you're filing head of household or filing single, then that number looks a lot more like $250,000, where you would start to phase out, not phase out, but you kind of get less benefit from an S corporation. You should think about doing something else. So you're paying a really high tax rate. Also, key point, in some cases you can start to phase out of the QBI deduction. And I don't want to open a whole new can of worms on this, but the QBI deduction is a 20% of your business income deduction that you just get until and unless you phase out of it. So if you phase out of that, now you're being taxed 37 cents on every dollar, and you have more dollars being taxed because you don't get this 20% deduction, which 20% of $500,000 is $100,000 that now you have to pay tax on and pay it at a higher rate. So you just start to get really disincentivized at these higher income levels. And the way to think about this is to think about shifting some of that over to a C corporation. So you still probably want to have your S corporation. Here's your owner, and your owner is probably still going to have an S corp. But you're going to try and limit the amount of income in that S corp, and usually do this by sort of splitting up your business into two businesses. Find a dividing line in there somewhere, and we can talk about that, in more detail in other. It's a topic for another day, I suppose. But you have your S corporation. Split some of that profit out. If you have multiple revenue streams, that's a really easy way to do it. If not, you can sort of break out like a payroll company. But you break it out and shift some of that over to a C corp. And C corp is not always the right answer here. This is where it gets into everyone's individual situation. But you end up sort of funneling off income from your personal return to that C corp return to get you back under the threshold where you qualify for QBI, and where your taxable rate at the federal level at least is more reasonable, let's say 24-ish%. And instead what you're trading is income that is penalizing you and adding extra income because you don't get the deduction, and you're trading a 37% rate, trading a 37% tax rate for a 21% tax rate, flat tax at the C corp level. There are other nuances to that, other details. I'll leave that for another day. Point is, as your income starts to get above this $500,000 mark, that's for married filing joint. It's less for individuals. Filing single or head of household, it's about $250. That's the time when you need to start thinking about doing something else with it. It's not always, a flat rule at $500,000 you need to have this other business. It depends on circumstances, but that's the time when you need to start asking yourself this question and running through the numbers for it. Fourth, if you have passive income. The reason for this one is pretty simple. If you have passive income, which generally the big one here is rental real estate. So you've got a real estate property that you're renting out, that is passive income. You don't need an S corp because that passive income is not subject to self-employment tax. So there's no incentive to use an S corporation at all for passive activities. You can still have the LLC that owns the rental. That's for legal protection, but you don't need it for taxes. There's no reason to mess around with an S corporation unless you have an operating business. And you always want to separate those two. Here's you have one LLC over here that's an S corp for your ordinary income, and then think of it like a dotted line. Mark Kohler always talks about this dotted line, and it's a good way to think about it. The dotted line, ordinary income is on one side, and passive income is on the other. And over here, this is where you would do your rental real estate through an LLC that is not an S corporation. And finally, the half a reason why you shouldn't use an S corp isn't really a reason not to use an S corp. It's just it's a way that people use S corps but don't get the full benefit out of it. And that is when you have a big old fat salary from your S corp. So if you're taking a big salary from your S corp, let's say you're taking a $200,000 salary or $300,000 salary, you're defeating the purpose of the S corp. It doesn't really make sense to have it at that point because you're paying so much in payroll tax and in wages that you might as well, at that point, just have it as self-employment income from a partnership or anything else. But really what you should do is just pull those wages down. Now, the biggest reason why I see really high wages is because people messed up on this first one. And they have an S-Corp partnership, S-Corp with multiple owners. And so one owner is doing the work, the other one's passive. So the one's doing the work has to have the big salary. But that goes back to structure and fixing that structure so that you can really streamline your taxes. This one's a big one because, again, the number that I'll emphasize on this is 15.3%. This is how much you're paying on every single dollar of wages that you pay yourself. And quick little asterisk there. Yes, Social Security wages do cap out at like $147,000, $150,000. But even after that, then you start kicking in with the additional Medicare, Medicaid tax. So you're still paying, 6 cents on every dollar above that amount. Point is, you're getting big chunks of money siphoned off of every dollar you pay yourself in wages. So you're really incentivized to keep those wages as low as reasonable given your profession. But if you're going to have really high wages, if you're like a doctor or a lawyer and like a reasonable wage is tough to justify as something being low, then think about looking at other entity structures because you're not getting the benefit out of the S corporation that you really should be. Those are the 4.5 reasons to not use an S corp. Hope you found it helpful. If you have any other questions on this, the best thing to do, if you haven't already, is to join our weekly webinar. We have one every week, just about every week, miss one here or there, but there's a live weekly webinar where we'll go through our whole tax planning framework, and I'll show you the specific tools that you can use to lower your taxes, to set yourself up. This stuff is not rocket science. It's stuff that you have to understand as a business owner so that you can hold your accountant accountable, so that you can make sure that you're not caught unaware of something that's going on or a missed opportunity and paying thousands and thousands of dollars extra to the IRS every single year. So join us in one of our weekly webinars. It's the best way to learn more, best way to figure out where you might be overpaying in tax and more importantly, how you can fix it. Thanks.